David sent a question in via email this morning, and he wanted to know how would I do analysis on the following spread idea. Instinct tells me that a low capital leverage neutral to bullish stock position would be a good debit spread candidate. But he wants to consider buying 2 in-the-money calls and selling it at the money. So we're talking about sort of a ratio callback spread. Or maybe even calendar that, make the longs further out in time and sell the near term. I'd like to analyze this idea. How can I use your tools to do this? Well, we would use the custom spread tool to get a graphical interpretation of the position, then link to analysis, of course, to see what's in the news, potential for gains or losses, what we see in the stock chart that we might consider in that case. Is this a good strategy for our expectations? All right, and the follow-up question for that is yesterday, it was essentially not today, but today's monthly picks of the day for the covered call on PowerOptions was a position on save at 1750. Sell the 1750 call, buy the stock at 2008 for a max return or an ROI about 9%. David wants to know, wouldn't a spread, buying a 1250 call and selling a 1750 be better? The max gain is 120, the risk is only 380, and the ROI is 32%. And he goes, maybe you could demonstrate how to do this, how to do it with your site, and I'm missing something about the debit spread being better. Well, the only thing that is really missing about the debit spread being better or worse is a comment that we made a little bit earlier, that every investor has their own goals. They have their own risk tolerance, and they have their own targets. So one investor might be very comfortable with the in-the-money covered call on a $20 stock for a 9% return. And if an investor just started trading options and just applied to trade options, they might only be allowed to do covered calls, level 1 trading. There's nothing wrong with a debit spread, and we, as mentioned, we use debit spreads in our portfolio. I've used debit spreads and credit spreads, vertical spreads, I'm sorry, David, in my portfolio. But there are variances that you can get, the debit spreads. There are pros and cons to each one, and that's what we sort of want to go through right now. So we're going to start with the second first. Let's go ahead and navigate over to PowerOptions. All right, and there we go. All right, so we're just taking a general look here at the PowerOptions trial account. Ours expires in 7 days, but of course you can always take a 14-day free trial to PowerOptions at any time. Now, I'm going to go to the portfolio tool, and we're going to take a look at these 2 positions. I programmed them in today, and we're going to talk about your other ratio back spread idea, Dave, in a moment. Now, the covered call picks of the day. These are what Ernie put together, the monthly picks of the day and the weekly picks of the day after extensive testing to see which covered calls perform best over time, over different trading ranges, market conditions, I should say. And one that came up yesterday was the save position, buying the stock at 2008, getting about $3.99 for that 1750 call. And as David mentioned, a max expected profit of 141 of time premium if assigned, or an 8.8% return. And of course, you know, that was from the update from yesterday that was posted before it was updated again today, but that's fine. Let's take a look at the profit and loss chart. What am I doing here? For just 100 shares in one contract, we're going to pay out to $2,008. We're going to sell a covered call, which enters us into a contract that we may have to deliver our shares of stock if it's trading above 1750 at July expiration. That would be the max profit. That's what we typically want to see if we're not married to this stock and we're not planning on holding it for an extended period naturally. So again, 141, we get $3.99, but we're giving some up to the intrinsic value. The stock's at 2008, so we're about $2.58 below the stock price. We're agreeing to give it up at $7.50. That's our intrinsic. The remaining price of 141 is our time value, our true profit, or the 8.8, roughly 9% return that David mentioned. We'd allocate essentially $1,600 out of pocket for this position after the premium was collected. And of course, as long as the stock stays above 1705, we make max profit. And we have a break even essentially at 1609 at expiration. Okay, standard covered call, pretty simple. What is the advantage of this position over just taking a Bull Call Debit Spread on Spirit, selling that same 1750 strike that we feel the stock's going to stay above because we want the max profit, but rather than buying the stock for 2008, buying the 1250 in the money call for 770 at midpoint price when I put this together. And there's that profit David mentioned of $120 off a risk of 380. I'd pay a debit of $3.80 or $380 per contract to enter this position. And of course, so the max return is 32% against the trade. Break even at expiration is 1630. What happens at 1630? Well, the 1250 call is in the money. The 1750 call expires worthless. We'd sell the 1250 call for that intrinsic value of 380, which equals the debit that we initially paid out. Okay? So you're paying a fifth of the cost to get a leveraged return. But in both positions, you can risk 100% of what you're investing if the stock goes to bankruptcy. But with the debit spread, if the stock falls below 1250, then you could lose 100% of what you invested in the position. Also, on a covered call, let's say we did originally open the stock at 20, okay? But let's say that if we had a 10% decline, we'd lose $2 on the position. If we had a 20% decline, we'd lose $4 and it would drop down to $16 per share. So let's say something happens. And by the way, this is not a recommendation or suggestion. This is just an example for David. And the reason why we're using the save here, but the stock pulled back about 5% today with the rest of the airlines and the cruise lines, again, because of fears of how they're going to manage going forward and the expectation of their earnings coming up in a month and a half or so. Okay, but let's just say halfway between now and expiration, the stock falls to 16. Okay, well, here's the expected values that we'd have for my covered call. I'd be down about $91. Okay, well, what's $91 of an investment of 1609? It's only about 5.5%, right? 6% of that value. So that's a little bit, I'm sorry, so yeah, it's about 5.9%, I think. Okay, so we're down $91. But with the stock falling 20% and the hedge that we collected against it because we own the stock, we're only down about 6% of the position. Now, if we do the same thing on the Bull Call Debit Spread, whoops, and the stock falls to 16 at the halfway point, we're about at the same monetary loss, aren't we? $92. But that's what? That's about 80%, 85% of the maximum risk we could take. We're down 85% of the expected max loss on the position. The lie of leverage works both ways, David. That's the pros and the cons. Is this a better structure and a better use of money? Potentially, if it works out. Naturally, we'd like to see a 32% return. Where's the real risk, though, other than what we just talked about? The real risk is discipline. And I'm sure, David, we've talked before. I know you're disciplined as well. But let's say I was going to invest $1,500, let's say $1,700 into a position. You and I both had $1,700 lying around and we wanted to try a trade. Well, I buy save at 2008. I sell that call for $399. So I have my cost basis of 1608, an extra 100 or so left over to manage the position. You go into the same position, you still have the same maybe $1,500, $1,600, $1,700 to play with, and you decide to put it all into this boat. So you got $1,520 invested, you're risking $480 on the position. Okay? Still the same ratio of 120 to 380 in this case, but it's $1,520 that you're risking now to 480. And if the stock, of course, now falls down to 16, it's going to be a loss of 368. Now, I'm going to be at a monetary loss of 368 as well, but that still means that I have $1,300 left to invest in the position. Okay? Because when it fell, I only did 100 shares in one contract, so I'm actually only losing 90 on mine, but in this case, because you did the multiple contracts, you'd be down $368, which is, still 85% of the max 480. But a bigger chunk of the $1,520 you invested, where I'm still only down 90. So it's give and take based on risk tolerance, and anytime you want to compare a vertical spread to a covered call, of course, you have to remember that you should not overtrade the position and not do too many contracts, because the lie of leverage can come back to hurt you. And, I could make the argument here, well, this is great to do a debit spread. Why wouldn't I do a bull put credit spread instead with the same probability of the stock staying above 1750? Trader's preference, risk tolerance, and more. Okay? There's nothing wrong with the bull call debit spread, David, if you're bullish on the stock. There's nothing wrong with the covered call if that's the strategy that you like and it's structured correctly to keep you out of trouble. There's nothing wrong with the bull put credit spread if you're sticking with the right probability and range out of the money as well. Pros and cons: lie of leverage, don't overtrade. There's nothing wrong with the debit spread in that case. Now, your other question was about this ratio call spread. We'll stick with the save example. So we were thinking about buying 2 at the money calls. Maybe we'll give ourselves more time in this case. We'll go to August, and the stock's at 18, so we'll call it the 1750, and we'll sell 1 20 strike out of the money. Okay? And you said to yourself, this seems like a good way to use leverage. Essentially what you're doing is an out-of-the-money bull call debit spread, aren't you? You're buying 1750 and selling 120, so essentially just an out-of-the-money bull call debit spread with a capped gain to the upside, as we saw before. And you've got about a 50-50 probability at this point, probably a little lower, probably 45% probability the stock will be trading above 20 on August expiration, and you receive the max profit. You've got pretty much a greater than 1-to-1 risk-reward ratio. In fact, this is how a lot of investors use the call debit spreads. Rather than go in the money where the calls have the wide bid-ask spread, not in this case because it's a lower price stock, they'll do simply the bull put credit spread out of the money. But when they do a debit spread, if they're bullish, they'll do it in this fashion. But then we add in another call to increase the cost basis and also do what? To leave the upside open, and effectively this is sort of like a ratio back spread. So you have infinite upside, a max risk of $550 if the stock drops below $750. The break even though is up to $20.50. Now this stock pulled back a little bit today. We saw that 5% decline. Maybe it's a little bit more than 5% at the end of the day. But what you're looking at here, David, now I want to analyze this position. What would be your goals on this position? Okay, well, you have a cost basis of $550, and you know that's your maximum loss if the trade goes against you. If it's trading below $17.50 at August expiration. You've hedged one of the calls here, and you can get this extra little jump between the strike prices because of the debit spread value, and you've left your upside open. But the stock has to move up almost $2 full before you get to the break-even price. Now that's true, that's at expiration, but even here at the halfway point in July 22nd, halfway between now and August expiration, you see that you're not expecting a lot of profit here in this case, okay, until you get probably up to about $20 per share. I know we were just there, and I know it's close. So you have this unlimited upside where you get this little kick here from the bull call debit spread, but you also have a risk of $550. When I look at this position, I just have to ask myself, why complicate it in this fashion? In other words, the call's at 445 at the 17.5 strike. Why not just buy one call at the 17.5 strike, have a risk of only 445, and leave the upside open? Does this extra 2.5 points from the debit spread really get you to a higher profit if the stock's at $22? Well, let's take a look here. If the stock's at $22.50, your spread here would have a profit of $213. Okay, and that's at expiration. I'm sorry, $200 at expiration. If the stock was trading right at 22. Okay, well, let's take this out. Let's just go to a long call. And we're paying $445 for $17.50. We do have a higher break even. That's a disadvantage. And if the stock goes up to 22, we're at a lower, I'm sorry, $22.50 here. Oh, it's not going to get it for me. Okay, but you can see that at $22.50, we'd probably be at a profit of only 50 cents, right? That's what it should come out to be, if I'm not mistaken, if I wait all the way to expiration. Yep, 55. So that extra $2 of profit that you saw, extra $1.50 of profit, where did that come from? It came from the debit spread. So it does have value. But the risk is slightly higher if it moves against you. That's the trade-off. The risk tolerance we were talking about, different goals for different people. So when you're analyzing, this is the tool I had mentioned in the email David would use. We'd use the custom spread tool here to see the graphical interpretation. Hey, if I just bought a call, what would happen? What could I expect if the stock was at X or Y at expiration, or roughly the halfway point on the position? Here I'd have a profit of 135 if the stock moved up to 22.50, about halfway between now and expiration. And then if I switched it over, and we switched it back to your ratio spread there, there we go, the out of the money 20 call, again, get the advantage of that $2.50 Bull Call Debit. Oh, I'm sorry. Let's try that again, shall we? How about that? There you go. So there's the $550 total cost, $890 in, $340 back, $555 cost. And again, if our stock's at $22.50 on Route 722, but we did $728 on the other one there, it's a profit of $197. So what am I projecting here, David? What I'm looking at is we would use other tools. We would look at the stock chart. You know, if you were entering this trade on Save, or if you had one already, you probably already would have looked at the stock chart, and you're saying to yourself, based on the movement of this stock recently, what is my expectation that it'll be trading at X or Y? Or you think you're neutral to bullish, and you're trying to use some leverage in this case. Well, your structure, as we just saw, I'm sorry, folks, your structure that we just saw takes on a higher maximum risk because the extra cost of the option, but can give a little bit extra kick if the stock continues to move up as you expected. Okay, so based on your expectation, you say your target is 22.50, and then I'd use the custom spread tool to just sort of compare. I'm sorry, wrong one. Which strategy would give me the best bang for my buck in this case if it happened? Now also, while we're here very quickly, if I did have a projection, and this is not my projection, this is not a recommendation or a suggestion, but if I had a projection that Save was going to be up to 22.50 on or around July 28th or so, what I'd do also is I'd go into the long call and go into the long option finder, and I'd put in the symbol, expected price of 22.50, and let's say we're about 500. So let's put let's say we'll put $600 potentially into options. And the expected date, we said July 22nd, July 25th, somewhere in that time frame. Okay, July 28th. All right, now what this tool just did is it went out and looked at every available option on Save, all expiration dates, and based on the price of the options and the expected price, if the stock did hit my target price and my target date, it shows me which option would give me the best theoretical return. And in this case, we were looking at the August expirations, 21st of August, but this one shows me that the August 15 strike call would actually give me the best return right now if the stock moved up to 22.50 from where it is right now at 18. And you say, wait a minute, that sounds silly. Why wouldn't I buy the 20 call that's out of the money for a cheaper price? Look at the volatility. Look at the prices. That the 20 strike call for August is probably more than $2.50. Okay, it's probably $3 or $4. I mean, the 22.5 for December is $4.80. The August 15 is $5.90 with a stock at 18. So that's probably around $3, which means if the stock goes to 22.50, you might actually not be at a profit with that out of the money call. But this tool is very helpful to help you identify which option will give you the best bang for your buck if you do have a target price of your position. Now I could go back to the profit and loss chart, could analyze the 15 call, and then do your approach too. What if I bought two 15 calls and sold maybe the just in the money 17.5, or just sold the out of the money 20? Would that match my targets, and would I potentially get a better return? So that's our discussion on comparing the debit spread to the covered call. Why would anyone do a covered call over the debit spread? And again, it's personal preference. And then, of course, we took a look at the difference between sort of this ratio call spread, the bull call debit with the extra long call to leave the upside open, and the pros and cons of the extra cost versus a little bit extra oomph from that debit spread inside the position and the extra long call as well. Okay, all right. I'm just scrolling down here, just take a look. Okay, all right, David, good, excellent, you're very welcome. All right. Now, another quick question that came in via email, but I did not have the time to write anything up about it right now. I'm just going to go back to the main home page here. This is from Chuck, and Chuck said, "And Mike, I was listening to some other webinar options trading instructors, and I'm going to use the search tool for Mary Puts real quick. We're going to talk about debit spreads here again. But what Chuck had asked is that one of the investors was looking at a debit spread of buying a 100 put, a 100 strike put. There we go. We'll use T-Mobile. Oh, is that in the money? Okay, let me find a $90 stock here. That's close. There we go. JP Morgan. Perfect. Okay. So of the two gentlemen that teach on this webinar that Chuck was watching, excuse me, I'm actually going to go to August again because it's 63 days out. And he was saying that one of them prefers to buy, say, a 100 strike put for a Bear Put debit and sell the 80 for a very low price. It's kind of what we looked at before when we were touching on David's question about sort of that out-of-the-money bull call debit spread. You get closer, the advantage here is you get closer to sort of a one-to-one or a greater than one-to-one risk-reward ratio. You knock down the cost basis only slightly. Oh, wait, I was just there. Pause for 1 second, everyone. I'm sorry. I don't usually like to do this. Let's see if it's updated. Here you go. 110 and 2. I'm sorry. This was a quick interrupt for a question that just came in. I meant to show this. Octavio said, can you share what the market sentiment tool 219? Yeah, it usually updates again June 19th. It'll usually update around 4:45, 5 o'clock when we're on the session on a Friday. So it updates at the end of the day, Octavio. So there it is now. We're at 110 and 2. And we'll talk about that more in a little bit. All right, back to our Bear Put debit spread. So what is the advantage here? It's relatively low cost. You didn't get that much against it because of that further out of the money premium, Chuck. You're absolutely correct. But if you're right and the stock falls down to this price, you're essentially at a 2-to-1 reward to risk ratio. That's the advantage of the out-of-the-money debit spreads, either bull call or bear put, is you're getting closer to a 1-to-1 risk-reward ratio or a greater than 1-to-1 risk ratio with this wider spread that Instructor A on the webinar you attended was discussing. And what most investors will do, and I believe Sam has commented on this many times before when we talk about it, if the stock fell to 90, they're probably going to be at a profit of $500, $600, almost even. Now that's a profit. So they're probably going to be able to close it out for $1,100. This 100 strike put is going to be worth around $10, $11, $12. So they might take this at a 50% profit because it was still a 1-to-1 risk-reward ratio for their trading plan. That's what he's probably doing. He's not planning on holding it to here with this probably, as you mentioned in your email, only a 20 or 25% probability of maximum profit. Your Instructor A is probably looking to close this position when he gets equal to or close to the max risk position as a profit. So the closing price here would be $1,100, $1,200, not the max profit of the full $1,300, but they'd make a profit of $500, $600, $650. They'd take it off at the halfway point. And so now if they lose it on the next position, it just goes against them and they start to lose. Well, the most they can lose is 668, which is equal to the return they just made on the previous trade. The idea is hopefully that when you have a loss, you're only wiping out one trade. Instead of with the credit spreads, the high probability credit spreads that I do, I'm taking a 7-to-1 to 8-to-1 risk-reward ratio. I know that. That's why it's so important that you close out at only a 50% loss when the credit spreads start going against you. So This is the trading plan, the more in-depth trading plan, I believe, Chuck, of this approach. Most investors who do the out-of-the-money debit spreads are going to close when they get to 50% of expected profit on the position, and they're keeping sort of a one-to-one total running risk-to-reward ratio. What is the advantage of doing it the other way? Now, I don't have a 98. I do. Let me go to July 13th. It's not going to be a fair comparison return-wise, but let's, again, buy the 100 put and sell the 98. It's at the money. It's got a 50% probability in this case. Clear that out. But what's the advantage of doing this tighter spread, even if it was at the same expiration, for example? Well, you still have a high percentage return because you're at the money, probably at about a 50% win-loss ratio, a 50% probability, excuse me, Chuck, of maximum profit. It's much lower cost, as you mentioned, because I'm getting a heck of a lot back against that long purchase price. Still having a good 50, 60, 70% expected profit, and now the stock can stay the same or move down slightly, and I'm still in the profit zone. I'm starting off in the profit zone instead of starting off in the loss zone with the other spread. The other spread, the spread from instructor A, I consider it to be, sorry, there we go. It has a lower reward to risk ratio. It's pretty much close to 2 to 1 in this case, which is phenomenal. So you've got a low reward to risk on the A. It is much more, I'm sorry, I shouldn't put B there. It is much more speculative because he needed the stock to fall further to the 90, 80, 95, 96 range before profit started to be seen, and he'd probably get out at the halfway point if the stock fell to 90. So it is more speculative, bearish structure. And it also came with the higher cost, but of course led to the potential higher return. Instructor B is a little bit more conservative. It's taking on a lower cost debit to the position, still has the profit for a good almost 1 to 1.5 risk-reward ratio. So you're taking on more risk than the reward in this case, but you have a higher probability of success on the trade in achieving the maximum profit. Okay? So that's sort of the comparison there between the two, Chuck. I believe they both have their places. In this case, with JP Morgan at 97.81, I know instructor A that you mentioned, you saw that he had the cost of 600. I'm pretty sure by the way investors I see trade those out-of-the-money debit spreads that they'd be looking to close at a 50% profit. They're not looking for the full 1,300. They're not expecting to get the maximum profit on that spread. If it happens, great, but they're not expecting it. They're probably going to close it when they have 50% of their expected max profit or the cost of the debit that they put in, meaning the profit would be 668. The liquidation would be 1,200 or so. The profit would be 660, equal to what they paid into the price as well. Now, you know me, I prefer, with a stock at 97.81, I'll be honest with you, if I was structuring a out-of-the-money Bull Call Debit Spread, or Bear Put Debit Spread, as we were just talking about, my apologies, I would probably be selling the 95 and buying the 100, right? Because it's right around 97.50. It's almost right between. So I'd sort of be straddling it with 2.5 point strike differences, or maybe the 100 to the 96 with the single strike options available. If I was doing a Bear Call Credit Spread, now this is only a debit spread. If I was doing a Bear Call Debit Spread, I'd probably want more safety. I might be selling the 103 and buying the 105 to have a 75, 80, 85% probability, but my numbers would be reversed. I'd probably be making it, let's say I sold the 103 and bought the 105, I'd probably be taking in 25 cents on a 2-point risk, or really a 175. So I'm going to have a much smaller return, but I've got the higher probability of getting that return because now the stock can stay the same, move up 6 points, move up 7 points, and I'm still essentially at full profit on the position. Okay? Great. All right, so that's where our email questions, and I'm going to go to one of Octavio's questions right now first that he just chimed in, and then we'll go back to the top of our list for those of you that have been waiting. Octavio says, can you use this as a hedge? And I'm assuming you're meaning, can you use the Bear Put Debit Spread as a hedge on a stock? And the idea is I don't want to. See, if I'm using a put for a hedge on my stock, I want it to have this to counter the loss if the stock really drops. Using a debit spread or a credit spread as a hedge against the stock position is dangerous because you only make back the maximum profit. Sure, you're getting it at a lower cost, but once the stock falls, what is the max profit here? Is $85. So once the stock falls down more than $85, you've got no more hedge. The stock falls 20 points, you've only hedged 85 cents. It didn't help you. It helped you pay 85 cents, not to help pause a 10, 15, 20% volatility on the position. Let's take a look here now that we've seen it. I want to leave that long put only open because now the risk is still what? Just 85 cents off of the maximum risk. Okay, I don't consider a debit spread or a credit spread to be a good hedge against the stock or a short stock position, because in that case, if the stock continues to fall, you haven't really protected it. You've capped the protection by the short put to try to get a lower cost. And while we're on this topic very quickly, I'm sorry, Bill just commented in. He says, I've heard with vertical credit spreads that one losing trade can wipe out the profits on 10 or so more winning trades. Other than closing them out early, what are the different setups that would reduce that ratio, like one losing trade wiping out maybe 3 or 4 winners? Taking a lower probability. It's as simple as that, and it's not advisable, by the way. Okay? Remember the debit spread we just showed, and we could consider this a vertical, Bill. In this position, I'm close to a 1-to-1 risk-reward ratio because I'm right at the money, which means what? I have a 50% probability of being successful on this trade. It's a low probability, well, it's a medium probability trade, but in general, when I'm doing credit spreads, we want to be at 80, 83, 85% probabilities, but nothing's free. When you take that higher probability, what do you end up with? A risk-reward ratio of 6-to-1, 7-to-1, or 8-to-1. When you take a lower probability trade that could, go against you quickly, if the stock just moves up 2 or 3 points from where it is, and you're in the red zone, I take the full loss of 115, I've maybe only wiped out 1.5 trades. If I initially sold the 100 and maybe bought the 102, let's take a look at that. That's probably going to be reverse. In that case, we're probably going to be at a debit of, no, I'm sorry, it's going to go the opposite direction. We're probably going to be at a debit of maybe 140 with a max profit of 60. But we have a higher probability of the stock staying below 100 and earning the maximum profit. Okay? And so I think there's a Sam's comment that just came in that I was just about to bring that up on as well. He says, every trade depends on market condition. It is important which strategy to apply in this, to the market reacting in a toppy manner. And you think the market is red and there's a pause. Fed is doing everything to the economy to help not make it crash. So what does that mean? Think about last week. Okay? Think about last week, Bill. Thursday. Now, I had 4 credit spreads open, and 2 of them I got out at for a 50% loss of the expected max profit. That still kept me within my target goals for managing the position and still keeps you at my 86, 87% success rate for 2020 with that strategy. Having not traded that strategy from about February 27th to April 3rd or 4th. Right? I took all of March off for reasons obvious. And I'm talking just bull put credit spreads. But if I had a portfolio, if my trades, I had 3 or 4 trades here open at the time, and well, okay, reverse it. If it was a bull put, Phil, and the stock had that 1800 swing we saw, all 4 of them would be at 70, 80% loss at the time. Okay, not 50, because where was I? I was down here. So it had to fall to this point and then lower before I could take the loss. You were taking a loss right here when it first hit my short put strike price. It's great to see things and talk about it visually. Let's look at some numerics very quickly. We'll just go to bull put credit spread, and I'll go to my search, Bill. And when I say my search, I mean the PowerOptions default bull put weekly screen. With these jumps in these markets, doing credit spreads or debit spreads that are that close to the vest consistently can be a little bit nerve-wracking because you've got a lot of spikes in both directions. So the bull put weekly, I typically look for an 85% probability, 14 days out in time, and my target is usually around 14.5%, 15%. Volatility where it is, the top 4 in the 17, 16% ratio. It's a little bit higher. But let's take a look here. The minimum net credit on this last position at 17.3% potential return, 89% probability. It's on NXPI. 30-cent net credit on a 2-point spread. So the max risk is what? It's going to be 170. That's the most I can lose, right? Because I take in the 30 initially, I can only lose 2-point maximum if it falls below 102 from 117.27 in that case. But I keep the 30 cents, and most I'm going to lose is $1.70. Let's call it a 6.5 to 1 risk-reward ratio. Oh, no, let's do it this way. I apologize. Let's go to NXPI. That would make more sense. I was going to do something else to just show individually, but let's keep it on the same stock. We're going to go to the search by symbol tool for that expiration cycle. It might be huge, but just because it's got single strikes. Okay. So, stock's at 117. I did a bull put now. We're doing bull puts. If I sold the 115 at the money and bought the 110, I'm going to get a 178 credit for that 4-point risk or so. Oh, sorry, 322 risk. All right, so I'm at a 2 to 1 risk-reward ratio and a high percentage return of 55%, but only a 55% probability. And if this stock falls 8% from another drop like we saw last Thursday with the rest of the market, I'm below both strike prices and at maximum loss. Where on the 104, 102 with the higher probability. And yes, the 6.5 to 1 risk-reward ratio, I'm still out of the money. It isn't as threatened because this is too close to the vest, in my opinion. So you can structure credit spreads to have a closer to 1 to 1, 2 to 1, or 3 to 1 risk-reward ratio, but you're sacrificing probability. Okay? And if there's jumpy markets, like we're in uncertain jumpy markets, if the stock falls suddenly or goes against the position suddenly, you may find yourself between the strike prices and at a partial loss or at 50% loss, where the further out of the money spread would still be safe. Okay? So everything is give and take and risk reward. You can structure them. My advice to you, I feel personally that if you want to go closer to the vest and you want to get more of that 1 to 1 risk reward ratio or 2 to 1 risk reward ratio, I'd suggest doing it with the debit spreads rather than the credit spreads. Okay? It's just a personal opinion, and you saw that the structures there when you're using an out-of-the-money bull put, for example, or bear put debit spread that we saw with that high risk-reward ratio, you're giving up a lot of probability, but at the same time, that short put is out of the money, wasn't it? On that JP Morgan buying the 100 and selling the 80, we're 18 points out of the money on the put that we sold, so we don't have to worry about early assignment. Shouldn't have to worry about early assignment anyway because we have that extra long put in the debit spread to cover it. But it's also easier to manage those if the stock is between the strike prices. What do I mean by that? So if I go here, here's our bull put credit spread again, Bill, and the stock's right here at 117. We've got pretty much close to 2 to 1 risk-reward ratio, don't we? Potential 55% return and a 55% probability. But this is a credit spread. This is a sold put. This covers it, but only if the stock's below 110. What happened if the stock falls to 113? It's only a 4-point move. That's reasonable. You're obligated here. You may end up having to buy shares of stock at 115 because your short put's in the money. The long put hasn't kicked in yet. Okay? So if you did 10 contracts, that might be pretty expensive. But again, you could turn around and sell to close the stock if it was put to you, and you shouldn't be losing that much money. I'm sure some of you read about it. A very, very sad thing that came out. It was Arizona. I can't remember if it was from Arizona. It was a young kid, 20-year-old kid, very responsible. He'd saved up $16,000, and when he lost his job, he was living at home with his parents, and he started trading. And he started trading options. And it's, I wish I could have talked to him. I wish I could have, he could have called me, he could have called Robin. I wish he would have, but he apparently killed himself earlier this month because he looked at his Robinhood account and saw that his cash balance was negative $730,000. And it's possible that he was in a bull put credit spread, maybe trading on Amazon or something else where he only had a true risk of 5 points. But the stock was between the strike prices, and it looks like he was going to have to pay $730,000 to cover the shares of the naked put or perhaps the call that the spread hadn't helped it with yet. So he got scared. He was very upset, of course, naturally, but he didn't understand how he could even be allowed to do that with so much margin. He thought his life was over, and unfortunately, he took his own life. It's very sad. But even if it was put to it at that price, he would have been able to sell it, or Robinhood would have done something where he wouldn't have been hurt too much, but he didn't know enough. And he was very upset with himself, and he didn't think he'd ever be able to get out of the hole if he took $730,000 in debt. And but that is the outcome of some of these positions that can happen. Okay, if it falls between it in a credit spread, Bill, what I'm talking about, if it falls between the strikes in the credit spread, you may end up being put shares of stock. That's why it's better to do those ones with the lower probability as the Bull Call Debit Spread. So if it falls between, this call's out of the money, it expires, you don't have any further obligation in that situation. Okay. Oh, okay, William, I didn't see that. I read a couple different articles as well. His brother or his cousin-in-law is in the financial industry, and William, he said he was also trading options on futures, so it might have led to that as well. So, yeah, it's still very sad, though. I was very upset to see that, and yeah, so, all right. Let's move on now to our questions that came in live. Bill, I hope that answers your question. The direct answer is you can structure them that way to get a different risk-reward ratio, but you're giving up probability and expectancy of max profit. A lot of investors use those more 1-to-1 risk-reward ratios or 2-to-1 risk-reward ratios with the debit spreads as opposed to the credit spreads.